This is a podcast from the Business Times.
Let's turn now to the issue of immigration and border security. President Biden, why should voters trust you to solve this crisis?
Because we worked very hard to get a bipartisan agreement that not only changed all of that, it made sure that we are in a situation where you had no circumstance where they could come across the border with the number of border police there are now. By the way, the Border Patrol endorsed my position. In addition to that, when he was president, he was separating babies from their mothers, putting them in cages, making sure the families were separated. That's not the right way to go. What I've done since I've changed the law, what's happened? I've changed it in a way that now you're in a situation where there are 40% fewer people coming across the border illegally. It's better than when he left office. And I'm going to continue to move until we get the total ban on the total initiative relative to what we're going to do with more Border Patrol and more asylum officers.
President Trump?
I really don't know what he said at the end of that sentence. I don't think he knows what he said either.
Well, I also had trouble following a lot of what US President Joe Biden said during the CNN presidential debate on the 27th of June, which reportedly drew more than 51 million viewers. In fact, the 90-minute debate left me wondering why on earth Biden and Trump are being put forward by their respective parties for the highest office in the country. Are there really no better candidates for the job than these two men? Welcome to the BT Mark to Market podcast. My name is Ben Paul, and I'm a senior correspondent at the Business Times. This series of podcasts, which is based on my weekly column in the Business Times, aims to provide analysis and insight on market trends and corporate issues in Singapore. We're in the month of July 2024, and one of the biggest news stories in the world right now is the weak performance of US President Joe Biden at the first US presidential election debate last month. For me, it was a big disappointment. I remember feeling relieved when Biden managed to defeat Trump in November 2020, and I remember thinking at the time that US politics and geopolitics were about to return to normal. But it looks like Biden may find it hard to defeat Trump again. Now, I'm not going to make US politics the topic of this podcast, but I do think the recent political turmoil in the US and in other developed countries marks a turning point in economic thinking, which could have a slow-moving but significant impact on global financial flows. I was still at university when the Berlin Wall came down, marking the end of communism in Europe. Around the same time, the ideas of Friedrich Hayek were shaping policy in the UK under Margaret Thatcher, and the world was embracing Milton Friedman's philosophy that the social responsibility of business is only to increase profits. Among the most admired companies of this era was General Electric, run by the legendary Jack Welch, who relentlessly pruned business units that were vulnerable to competition and invested in those that were the lowest cost players in their respective markets. Jack Welch also advocated the regular culling of the bottom-performing 10% of GE's employees. Meanwhile, governments cut taxes and regulatory red tape and encouraged the cross-border flow of goods and capital. Companies moved production to lower-cost countries and ruthlessly maximized shareholder value. During this period, inflation also seemed to stabilize and interest rates fell steadily. Long story short, it was a glorious time for the corporate sector and financial market investors. But there was a problem. Economic liberalism wasn't working for everyone. Prosperity was not being widely shared. Middle-class incomes in the West stagnated in the face of technological advances and automation, and large corporations moving production to lower-cost countries. Not surprisingly, these trends developed a political dimension. In the US, Donald Trump rode to the White House in 2016, promising to undo major trade deals and bring jobs back to America's Rust Belt. Senator Bernie Sanders, a self-confessed socialist who was the runner-up behind Hillary Clinton for the Democratic Party ticket in 2016, found a surprising amount of support among young voters. So there was clearly a sense among many people that things needed to change. There was also a sense among financial market watchers that the economic liberalism was resulting in pockets of excesses and instability. The chief investment officer of a Swiss private bank whom I interviewed about a year before the pandemic explained it to me this way. With stagnating middle-class incomes, demand had been increasingly fueled by rising asset prices and borrowings. Limited upward pressure on wages had also paved the way for a long-term decline in inflation and interest rates, which further fueled asset prices and enabled everyone to borrow even more. Monetary policy at that point was no longer about curtailing inflation, but preventing asset prices from collapsing. This CIO went on to tell me that big technological advances do not necessarily benefit ordinary people, and that pressure on middle-class wages would persist into the future. He pointed out that global economic growth during the decade that followed the launch of Apple's iPhone in 2007 was actually lower than the decade that preceded it. Of course, there was a global financial crisis just after the iPhone was launched, but I thought his views were generally well-founded. The iPhone has greatly enriched Apple's shareholders, employees, and suppliers. Yet smartphones have also contributed to the disruption of sectors such as media, telecommunications, and transportation. For many people, smartphones are now an indispensable life tool, but few people would say these devices have made them materially better off. With the big gains chalked up recently by artificial intelligence plays such as NVIDIA, is AI going to be the next big technological wave that destroys middle-class jobs, drives down inflation, and worsens inequality? Or is the emergence of politicians such as Donald Trump a sign of fundamental change in the political economy that will keep inflation and interest rates up? What would that mean for the corporate sector? And what should investors do? I'm going to talk about that next.
Money Hacks now comes to you every Monday. Get useful financial tips every week. How much to save, what to invest in, how Elim asks the experts, so you have the answers. Money Hacks by the Business Times. Every Monday, go to bt.sg/moneyhacks or wherever you get your podcasts.
And now, back to Mark-to-Market from the Business Times.
One of the difficulties with forecasting inflation and interest rates right now is that we're still in the midst of an unusual economic cycle. The COVID-19 pandemic created a demand shock as well as a supply shock to the global economy. On the one hand, millions of people around the world were suddenly not indulging in consumption activities such as traveling and shopping and going out to eat. Many of them just stayed at home and accumulated savings. On the other hand, millions of people around the world were also suddenly unable to go to work, which caused global supply chains to break down. This created the risk of inflation even when economic activity was flat on its back. In fact, when the pandemic restrictions were lifted, inflation took off very quickly as pent-up demand collided with supply chain bottlenecks and weak labor force participation rates. Now, US inflation has gradually come down from the peak levels they hit in 2022, largely as a result of the reversal of those pandemic-related distortions to demand and supply. But inflation has evidently not receded enough for the US Federal Reserve to actually loosen monetary policy. The FOMC decided at its most recent meeting to maintain the target range for the federal funds rate at between 5.25% and 5.5% for the seventh time in a row and continue reducing its securities holdings. The FOMC meeting participants also raised their forecasts for inflation for 2024 and 2025 and reduced their predictions for rate cuts in the immediate term. Their median projection now is for the federal funds rate to end this year at 5.1%, which implies just one 25 basis point cut. Back in March, they were projecting a federal funds rate of 4.6% by end 2024, which implied 3 rate cuts. Their latest median projection for the federal funds rate by end 2025 is now also higher at 4.1%, up from 3.9% back in March. They're also projecting a longer run federal funds rate of 2.8%, up from 2.6% in March. Is this a reflection of some fundamental change in the US economy and global economy? Should we not expect inflation and interest rates to fall all the way back down to their pre-pandemic levels? This is a question that's been asked before at post-FOMC meeting press conferences, and the answer from Federal Reserve Chairman Jerome Powell so far has been that nobody knows for sure. After the most recent FOMC meeting, Powell told reporters that meeting participants were coming to the view that rates are less likely to fall back down to their pre-pandemic levels. But he went on to say that he did not completely discount the possibility that rates and the US economy are just experiencing a series of persistent but ultimately temporary shocks. My own view is that it is only a matter of time before the Fed begins cutting rates because inflation has been slowing and interest rates are currently at a restrictive level. Moreover, other major central banks are already lowering their policy rates. Last month, the Bank of Canada and European Central Bank kicked off their rate-cutting cycles. The Swiss National Bank recently cut rates for the second time. But it seems unlikely to me that US inflation and interest rates will sink all the way back down to their previously low levels. This brings me back to the shift in economic thinking and political currents that I talked about earlier in this podcast. Rightly or wrongly, there is an underlying pull away from the economic liberalism of the last 40 or 50 years. Middle-class voters in the West seem to have a lot of grievances, and they're willing to vote differently. There are also growing geopolitical tensions. President Biden and former President Trump disagreed with each other about almost everything during their debate, including who's the better golfer. But both of them have clearly demonstrated that they favor placing tariffs on imports from China. There is also a risk of further inflationary impulses from troubled parts of the world. After Yemen's Houthi rebels began firing on ships entering the Red Sea en route to the Suez Canal late last year, vessels have been taking longer alternative routes to their destinations. This has reportedly disrupted sailing timetables and resulted in ships offloading larger amounts of cargo at big transshipment hubs such as Singapore. A news report last month said that it costs more than $6,700 to transport a 40-foot container from Shanghai to Los Angeles and nearly $8,000 from Shanghai to New York. This is up from $2,000 in December last year. This combination of factors, a changing political economy, reverse globalization, and a generally more fractious world suggests to me that the corporate sector will have to cope with suboptimal supply chains and generally higher costs. This isn't necessarily bad news for investors here in Singapore. In the first place, the key beneficiaries of increased US-China trade frictions are likely to be the main ASEAN economies. Analysts and bankers have observed for some time that some manufacturing operations in China are relocating to ASEAN. Also, as I mentioned earlier, it's probably only a matter of time before the US begins cutting rates. This would take pressure off currencies in this region and encourage the flow of capital to markets here. Another important reason the Singapore market could be interesting going forward is because of the potential for value to be unlocked through corporate restructurings. This is something I've discussed before in this podcast series. In recent years, we've seen heavyweight companies such as CapitaLand, Keppel, and Sembcorp Industries undertake extensive reorganizations of their businesses, resulting in their shares garnering substantially better market valuations. A continuation of this restructuring trend in sectors such as telecommunications and real estate could keep drawing investor attention to the Singapore market in the months ahead. So how exactly should investors position themselves to ride these trends? My view is that there isn't any point in getting too creative. The Singapore market has not performed well for years, but the leading companies in the local market are generally in good financial shape, pay decent dividends, and are not excessively priced. A general flow of institutional money to the region is likely to benefit the largest and most actively traded stocks in Singapore, such as the three banks, DBS, OCBC, and UOB, as well as other heavyweight index stocks such as Singtel, ST Engineering, and Wilmar. Real estate investment trusts under the CapitaLand and Mapletree umbrellas, which are among the largest and most liquid in the market, would probably also benefit from a flow of institutional money to Singapore in the event global interest rates fall. The next couple of years could be an unsettling time for global investors, but the Singapore market could well be an oasis of relative calm. That's it for this edition of Mark to Market. I'm Senior Correspondent Ben Paul at The Business Times.
This is a podcast by The Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.